Something just happened that the mainstream financial media is barely talking about. Not a war, not a stock market crash, not a Federal Reserve announcement. Something quieter than all of that. Something that happened in a government office in Beijing, buried in policy language, filed under tax reform, ignored by every major news outlet in America. And yet, it may be one of the most consequential moves for your money, your energy costs, and the future of a critical metal that the entire modern world runs on. China made a move. And when China makes a move in commodities, the whole globe eventually feels it. Here's what happened. China's government officially eliminated its 9% VAT export rebate on solar products. Canceled. Zero. Done. Now, I already know what some of you are thinking. VAT rebates? Tax policy? Come on, man. I came here for investing content, not an economics lecture. Stay with me, because by the end of this video, you are going to understand exactly why major banks are sitting in emergency meetings with very uncomfortable spreadsheets right now. Why deliverable silver inventories on the COMEX exchange just fell 13% in a single month. Why Deutsche Bank is publicly calling for silver at $100 per ounce. And why one of the world's largest tech corporations bypassed the global silver market entirely, going straight to a mine, to lock up metal before it runs out. This is the story of the most important metal most Americans aren't paying attention to. And the window to understand it, before everyone else does, is closing fast. Before we can talk about what China did, you need to feel the world that silver lives in, because without that context, the China move just sounds like boring policy. With that context, it sounds like a lit match dropped into a room full of gasoline. Silver is not what most people think it is. Yes, it's in your grandmother's ring. Yes, it's in the coins some people stack in their basements. But the real story of silver in the 21st century is an industrial story, a technology story, a civilization story. Silver is the single most electrically conductive metal on the periodic table. That one fact, a fact of physics, not opinion, has made silver irreplaceable in the modern world. Every solar panel produced anywhere on Earth requires silver paste to conduct electricity. Without that silver paste, the panel is just expensive glass sitting in a field. It generates nothing. Every electric vehicle runs on electronics laced with silver. Every AI data center, the ones being built right now by Google, Microsoft, Amazon, and dozens of others to power the artificial intelligence revolution, requires silver in its power distribution and cooling systems. Every touchscreen you have ever swiped, every 5G antenna on every cell tower, every medical device in every hospital, every advanced weapon system in the United States defense arsenal, all of it requires silver. And here is the number that should stop you cold. The world uses over 1.2 billion ounces of silver every single year. Global mines produce roughly 850 million ounces. That is a gap, a structural deficit, of hundreds of millions of ounces annually. The Silver Institute, the most authoritative research body on this market, projects the 2026 deficit alone at 67 million ounces. And this is not a one-time thing. This is the 6th consecutive year of structural deficits. 6 years in a row where the world has consumed more silver than it produced. The cumulative drain since 2021 alone exceeds 820 million ounces pulled from above-ground stockpiles. Think about that with a simple image. Imagine you have a bathtub filled with silver. Every year, you pour in 850 gallons. Every year, you drain out 1.2 billion, year after year after year. Eventually, and this is not a matter of opinion, this is mathematics, you hear the drain gurgle. The bathtub runs dry. That gurgle? That sound? That is what the silver market is making right now. And into this already stressed, already structurally broken supply picture, China just dropped the hammer. For years, China's solar manufacturers enjoyed a quiet but powerful financial advantage, a 9% VAT export rebate from the government. Every time they shipped solar panels, inverters, solar cells, or modules overseas, the Chinese government handed them back 9 cents on every yuan of value exported. It was a subsidy, a competitive weapon. It is part of how Chinese solar manufacturers came to dominate 80% of global solar panel production. 80%. Let that land. 4 out of every 5 solar panels installed anywhere on Earth, on your neighbor's rooftop, in the massive solar farms spreading across Texas and Nevada, in projects across Europe and Southeast Asia, were made in China. Then Beijing canceled the rebate. Completely gone. The official explanation was reasonable sounding. Reduce price dumping, ease trade frictions, promote rational market price. But regardless of the stated reason, the effect was immediate and massive. Chinese solar manufacturers faced a sudden jump in effective export costs. Solar module costs are projected to rise by 5 to 10% from the rebate cancellation alone. Overall solar project costs are expected to climb approximately 10%. For an industry already operating on tight margins, this is not a rounding error. This is a structural repricing of one of the world's most important industries. But here is where silver enters the story, and where it gets genuinely explosive. Silver paste is not a minor ingredient in a solar panel. It is a critical, non-negotiable component. The paste conducts the electricity that the panel generates. There is currently no commercially viable substitute at scale. And because solar cell technology has become more advanced and more efficient, the silver content in each panel has actually grown more critical over time. Silver paste now accounts for somewhere between 17 and 29% of the total manufacturing cost of a solar module. Nearly a third of the cost of every solar panel on Earth is silver. So when the cost of exporting those panels rises, manufacturers do not quietly absorb the hit. They scramble for efficiency everywhere they can find it. They stockpile inputs before costs rise further. They buy silver now, rather than pay more for it later. And that is exactly what happened. Chinese manufacturers and industrial buyers went on a silver buying rampage. Imports surged to their highest level in 8 years. In a single month, a record month, China pulled in 470 tons of silver. Combined over 2 months, that is over 790 tons, more than 25 million ounces, flowing from global vaults into China's industrial pipeline. They did not buy gradually, they bought aggressively, urgently. Because they knew the window was closing, the result was visible in real time. Physical silver prices on the Shanghai Gold Exchange broke sharply away from Western paper benchmarks. The premium of Chinese physical silver over COMEX and London futures prices reached 12 to 13%, a divergence that market historians called among the most extreme ever recorded in the modern silver market. Metal was moving, from west to east, from global vaults to Chinese factories, and the West was beginning to notice the empty shelves. Here is where the story gets truly fascinating, and a little bit terrifying if you understand how financial markets actually work. The COMEX exchange in New York is where silver futures are traded. For decades, it has been the global pricing mechanism for silver. Banks, funds, and institutions trade enormous quantities of paper silver contracts, promises to deliver silver, backed by silver held in vaults. At various points in history, the ratio of paper silver contracts to actual physical silver in those vaults has reached as high as 356 to 1. 356 paper ounces for every 1 real ounce. This system works fine, under one critical assumption. The assumption that the vast majority of contract holders will never actually ask for physical delivery. They will roll their contracts, take cash settlement, move on. The music keeps playing as long as everyone keeps dancing. In early 2026, people stopped dancing. They started asking for their silver. COMEX registered silver, the inventory that is actually deliverable when someone calls a contract, now sits at approximately 76.4 million ounces. Sounds substantial. But registered inventory has already fallen roughly 64 to 75% from its 2020 peaks. And in just the past 30 days, it dropped another 13.1%. 11.6 million ounces drained from deliverable stocks in a single month. In one particularly dramatic week alone, more than 33 million ounces were physically withdrawn for delivery, approximately 26% of COMEX's registered inventory gone in 7 days. Meanwhile, commercial short positions, banks and institutions that have sold silver they do not actually own, betting that prices would fall, stood at 275 million ounces net short. That is 275 million ounces of promises to deliver silver at lower prices, made at a moment when physical silver is actively draining out of the system. This is the textbook definition of a short squeeze. Except this is not some Reddit-fueled meme stock. This is a critical industrial metal that powers the green energy transition, the AI revolution, and the global defense industry. The institutions that are short silver need to cover. To cover, they need physical metal. Physical metal is leaving the building, faster every month. You do the math. And here's the piece of the picture that most mainstream coverage completely misses. The large industrial users, the manufacturers, the tech companies, they are not waiting for COMEX to deliver. They are going directly to the source. Samsung, one of the world's largest technology, finalized a deal obtaining the exclusive right to purchase 100% of a silver mine's production output for 2 years, bypassing the exchange entirely, going straight to a mine in Mexico to lock up metal directly. When a company the size of Samsung decides it cannot trust the market to deliver metal when it needs it, that tells you something profound about where we are. Let us talk about what the financial establishment is saying, because even the most conservative institutions have been forced to update their numbers. JP Morgan, one of the most powerful financial institutions on the planet, updated its silver price forecast to $81 per ounce average for 2026. Deutsche Bank went further, publicly projecting silver reaches $100 per ounce by year end. More aggressive analysts have put $125 to $200 on the table as plausible scenarios given the structural backdrop. A poll of 212 retail traders found 57% expect silver to exceed $100 per ounce in 2026. But here is what is even more telling than the price targets: the physical market signals that precede price explosions. Silver lease rates, the rate at which holders of physical metal agree to lend it out, have been climbing. When holders of real silver become increasingly unwilling to lend it even temporarily, it signals acute scarcity. The market is saying, I'm not letting go of this metal, not for any reasonable price. Simultaneously, the silver market has moved into backwardation, a technical condition where the price for immediate delivery is higher than the price for future delivery. In normal markets, you would expect the opposite. Future silver should cost more because of storage and carrying costs. When the market flips and immediate metal commands a premium, it is the physical market screaming, we need metal right now, and there is not enough. This combination, rising lease rates and backwardation, has historically been one of the most reliable precursors to sharp upward price movements in silver. And the gold-silver ratio, which has historically hovered around 80-1, compressed dramatically during the peak of the recent rally, suggesting silver is beginning to reclaim not just its industrial identity, but its monetary identity. Silver as money. Silver is a hard asset in a world increasingly skeptical of government promises and paper currency. For thousands of years, silver was money. Not metaphorically, literally. Civilizations were built on it. Empires were funded by it. And in a world where national debts are measured in tens of trillions, where central banks are printing currency at historic rates, where trust in institutions is at generational lows, investors are remembering that silver has intrinsic, indestructible value that no government can print away or hack into oblivion. Now the smart, skeptical viewer asks the obvious question. If silver prices are rising this dramatically, why do not miners just produce more? It is a fair question. And the answer is, what transforms this from an interesting market story into a genuine structural crisis? Silver is primarily a byproduct metal. Approximately 70% of all silver ever mined comes out of the ground as a secondary product alongside copper, lead, zinc, or gold. Mining companies do not decide to produce silver. They decide to mine base metals, and silver comes along for the ride. That means you cannot simply decide to produce more silver. You have to mine more copper, more lead, more gold. In that process, finding a deposit, getting permits, conducting environmental reviews, building infrastructure, hiring workers, actually beginning extraction, takes 7 to 15 years in most major mining jurisdictions. 7 to 15 years, minimum. In the meantime, demand is not waiting. Solar energy is growing at exponential speed. The energy transition, driven by climate policy, energy economics, and national security concerns, is expanding the global solar fleet at a pace that requires more and more silver every single year. Solar manufacturing alone consumes roughly 1/5 of annual global silver supply. And that share is growing. Electric vehicle adoption is accelerating. Every EV manufactured anywhere on the planet uses silver in its battery management systems, charging electronics, and power distribution networks. As the global fleet of electric vehicles multiplies from millions to tens of millions to hundreds of millions, the cumulative silver demand grows alongside it. And then there is artificial intelligence, perhaps the most underappreciated silver demand driver of this era. The AI boom is not virtual. It is intensely physical. AI data centers consume electricity at a scale that is hard to comprehend. Managing, distributing, and controlling that electricity at maximum efficiency requires high-performance electronics. And silver is at the heart of those racing to consume silver. The critical insight here is what one analyst called the impossible triangle. Demand that structurally cannot slow down, supply that physically cannot speed up, and a paper promise system that is being forced to confront the difference. Much of the silver consumed in these applications is gone permanently. It is not recycled. It does not return to the market. Unlike gold, which is melted, re-refined, and circulated again and again through centuries, silver is consumed. It disappears into panels, chips, and circuits, permanently removed from available supply. Every year of deficit, every ounce consumed in a solar panel or a data center is an ounce that cannot be called back. Here is where this stops being a global commodity story and becomes a very personal American story. The United States government recently added silver to the U.S. Geological Survey's critical minerals list. That is an official designation, backed by federal policy, that silver is strategically essential to American national security and economic competitiveness. Think about what that means. The same federal government that designates certain minerals as too important to leave to market forces, rare earths, lithium, cobalt, has now put silver in that category. Why? Because without silver, the United States defense industry cannot build its advanced weapon systems. Without silver, American solar developers cannot build the clean energy infrastructure required by federal mandates and state laws. Without silver, the United States semiconductor and electronics industries cannot manufacture at full capacity. And right now, the supply of that critical metal is being squeezed from multiple directions simultaneously. From the east, China, which controls 80% of global solar manufacturing and just repriced that entire industry, is absorbing physical silver from global markets at record rates. From the south, Mexico and Peru, two of the world's largest silver-producing nations, face ongoing geopolitical and tariff pressures that create uncertainty about supply reliability. From below, COMEX deliverable inventories are draining month after month. From the institutions, commercial short sellers are sitting on positions they increasingly cannot cover with physical metal. The consequence, for ordinary Americans, plays out on two levels. First, costs. Solar installations become more expensive. Electric vehicles become more expensive. Electronics become more expensive. Every element of the clean energy transition that America has committed to, through legislation, through state mandates, through corporate pledges, becomes harder and costlier to execute. That cost gets passed along to utilities, to consumers, to you. Second, opportunity. Silver, which was trading in the low to mid $20 range just 2 years ago, has already surpassed $100 per ounce in this cycle. Investors who recognized the structural story early, who held physical silver, silver ETFs, or shares in silver mining companies, have already experienced extraordinary returns. And the structural forces driving that move have not resolved. In several important ways, they have intensified. Let us be direct about where prices can go, and why the structural argument is stronger now than at any previous point in this rally. Silver has already proven it can trade above $100. That was not a fluke or a speculative fever dream. It was a physical market forcing a paper market to acknowledge a reality. The pullback since that peak is consistent with how every major commodity squeeze behaves. Moments of extreme price discovery followed by consolidation, followed by the next leg up as the underlying supply-demand imbalance reasserts itself. The structural case for $100, and potentially higher, rests on several pillars that are still firmly in place. The annual deficit is still projected at 67 million ounces. That deficit does not disappear when the price pulls back. It continues draining the inventory buffer that has historically prevented price explosions. COMEX registered stocks continue falling. Every month that registered inventory decreases, the paper-to-physical ratio becomes more dangerous for institutions holding short positions. Industrial demand is still locked in. Solar manufacturers, EV makers, AI data center builders, none of them have viable alternatives to silver in their critical applications. This is price inelastic demand. They pay what the market asks because they have no choice. And here's the piece of positioning data that few people are talking about. Speculative money is still light in silver. Net long speculative positioning sits at just 19% of open interest, compared to 31% for gold. Despite the dramatic price move, the retail and momentum trading crowd has not fully arrived yet. The rally so far has been driven by genuine physical demand and institutional necessity, not speculative frenzy.